We are putting on this event because we're at an interesting time in the financial services sector where we're seeing an increasing number of consumers look to fintech products to basically connect them to the financial system, and particularly young people aren't really thinking of traditional banks in the way that my parents did or even I do. A lot of them consider, frankly, Venmo to be their bank. And so we're looking at whether our regulatory system, both here and abroad, are keeping up with the changes while ensuring there is proper oversight. So we're very excited to have Director Chopra here from the Consumer Financial Protection Agency. And Director Chopra, I wanted to start off just talking about, the CFPB was born from the 2008 financial crisis. And because of that backdrop, I think there's a sense that, the agency has been a pretty tough cop when it comes to overseeing certain companies and protecting the interests of consumers. How do you see that oversight balancing with trying to also create an environment that allows for innovation, allows for creativity, especially for people who feel like they're not as connected to the traditional financial system?
Yeah, I really strongly reject this weird kind of norms of innovation versus kind of fairness. I actually
it's not
think,
one or the other.
Well, I think if you look at the history of our country, you find that techno-futurists, techno-optimists believe in democratization. They believe in more competition, more offerings. And I think the challenge can always be, really, what do we mean by fintech? Is fintech just a branding that you put on your company with a website to drive up valuation prospects? Or is it really something that you're creating a new way to solve a difficult problem that accretes benefits to all of society, and you get to take a lot of that too? And I think that's how we really look at things. So we really see a world where technology drives so much improvement in people's lives, but we are on the lookout for people who want to be gatekeepers and charge tolls through the whole system. We want to see who's exploiting, misusing, abusing data. And we also want people to build businesses on something real, not just kind of regulatory arbitrage. So we have taken the view, often the rules need to have brighter lines, they need to be simpler, and they don't need to be designed just for the very biggest incumbents, which I think is a little bit of the system that we have.
Yeah. And what is your approach to working with fintech companies, especially as rules may sometimes not be as clear and as simple as you would like them to be? Are you open to meeting with them to work through any sort of compliance issues when they have questions about that? Is there a back and forth that they can have with the CFPB?
Yeah, I mean, as you know, we inherit laws that are written by Congress. They're often written sometimes for very specific circumstances, sometimes they're written just very, very broadly. And we have to deal with that. And one of the things we try and do is we have tried to answer the call of making sure that fintech companies, startups, and future firms that don't exist don't have to deal with the shakedown of lawyers that are circling them, trying to get money from them by waving this flag of uncertainty. What we need to do is people understand you're never going to have perfect certainty in any major business decision. And you take calculated risks and you want it to go your way. We are, though, looking at our rules to try and figure out what will lower barriers to entry, what actually increases the number of people in the game. And boy, are we on the lookout for companies trying to insert themselves into the middle to be a must-have resource for everyone. and then totally price gouge people or totally find themselves able to have an unfair advantage. So we see that all over the financial system, and we so appreciate many startups and fintech companies coming to us and telling us, put a stop to this type of business model, and we're on it.
Yeah, and are you talking more in the traditional financial sector in terms of?
Oh no, I mean, we see a lot of capital from venture capital flowing to places that want to be middlemen, want to be gatekeepers, want to be the ones that charge tolls. I mean, we have small, big mortgage lenders trying to do really innovative things. And one after the other have essentially told us how the credit reporting and credit scoring conglomerates are absolutely price gouging them. Because the system requires that you have one of those scores and those reports if you're going to securitize, if you're going to play in the secondary markets. And so we are on the hunt to make sure that that price gouging isn't occurring, because all that does is harm real businesses and real consumers.
Yeah, and those companies are essentially sort of like an oligopoly. I mean, there's only a handful of them, and you don't really have many choices.
Yeah, I mean, we see it across sectors that oligopolies can get really lazy, and instead of really creating actual value, they figure out how to position themselves to milk the system. And unfortunately, a lot of venture capital flows to businesses that pitch themselves as being able to do that.
Sure. Well, talking about middlemen, some of us have been following the bankruptcy case of Synapse. For those of you who haven't been following, this company did act as sort of a go-between connecting fintech companies to traditional banks like Evolve, which cut off relationships with them and sort of started this downward spiral where we've seen, Americans with about $265 million in various accounts not able to access them. What is your take on that case in terms of what it says about this space, including for the banks themselves?
Yeah, so I think we've long had an issue with rent-a-bank in America, where it's really interesting. You sort of, fintech and the banking system have this sort of tense relationship where they both hate each other but both need each other.
Yeah.
And
They're
I think that
frenemies.
this is really a tough thing to navigate often. And many banks are marketing themselves as the bank of choice for fintechs. And sometimes that leads to situations where there is a kind of move fast and break things mentality, or things aren't really buttoned up. And in some circumstances that's okay. In other circumstances, like the Evolve Synapse fiasco, it's just catastrophic. We have in our country a sense that as a society, we want people to deposit money in the banking system, because us pooling our deposits creates I don't want to say free lunch, but a way to create economic growth and credit intermediation. And the reason it works is because we have federal deposit insurance. It's because we have lender of last resort discount window lending at the Fed. And we reserve a lot of those functions for banks. And I think when you have certain firms that don't even really know how the accounts are ledgered, I mean, this causes really catastrophic and monstrous harm to people. So we certainly are looking at the CFPB. We have been even before this fiasco about ways to safeguard it. Of course, the FDIC when it comes to brokering of deposits and making sure that banks or companies that hold themselves out as making their funds available like a demand deposit, that they can actually hold up to that promise.
Yeah, and are you looking at this specific case for any sort of action from the CFPB?
Well, I mean, I'm not going to say anything on that, but it's a huge problem, and we'll reserve judgment, but I think it's an obvious and serious lapse of judgment, whether it's a legal infraction we'll let people look at that.
Sure. Well, in terms of talking about innovation and sort of opening up the system a bit, the CFPB recently proposed rules around open banking. This is where, the idea that common sense, consumers own their financial data and they should be able to allow, with permission, have other institutions, namely banks, pass on that information, to other entities if the customer wants that. What is the timeline for that, and what do you see as the next steps? What does this open up if this is finalized?
Yeah, so just to level set, what we have put forth on open banking will activate some new rights from a dormant legal authority that sort of sat fallow for a while. So the hope is that you can really create a lot more competitive offerings when it comes to getting a higher deposit rate on your bank account, getting a lower rate or an approval where you might not have been able to on a credit product, and actually so much more. So phase one of this is really activating that, which we will finalize the rule by October. We're now entertaining applications for standard setting bodies whom we hope to accredit, who will then be able to set certain standards where companies can rely on that standard to make sure that they're in line with the rule. We will then, our first rule covers really transaction accounts, deposit accounts, digital wallets, others. We're then going to do a series of other rulemakings to solve different types of problems. So one problem is really how can we do more to make the mortgage market serve more people? And what's the ways that mortgage lenders may be able to address that? I'm thinking hard about whether that will be a rule for next year that we start.
Because the idea is by having access to that data more easily, they can
I think
offer.
what you see in mortgage lending is a lot of very powerful gatekeepers and tech companies who basically are charging a toll for every single mortgage transaction. So you have a mortgage lender, they've got to pay off someone, to do an employment verification. The Equifax work number is one of the big players charging a toll there. They got to pay big bucks to FICO and the credit reports over and over and over again. So we're trying to figure out what is the ways in which we can lower the costs for lenders and ultimately help consumers who may not have a long credit history, may not have a lot, but they have data that can support, maybe getting that loan. So that's one thing we're thinking about. We're obviously looking at the role of people's payroll information. How can people potentially better permission their payroll history and be able to get a real sense of how much they make? So we're toying with a lot of ideas on this, and we want to make sure that there can't be a company that just inserts itself in the middle of this and really wreck it for everybody. So we're trying to work out all of this, but the next big point will be this October.
Okay, got it. And on the buy now, pay later front, which has been, such a hot space in the fintech world, the CFPB recently came out with an interpretive rule that sort of applies some measures that are usually for the credit card industry to buy now, pay later firms. There has been some pushback on that. What is your sort of justification for why that should apply? And in terms of other entrants, we saw also Apple actually get out of this space. Is that a sign of the market working and sort of doing its job, that this is actually maybe harder than it looks, and that's something that the market can take care of as opposed to regulators?
Yeah, it's interesting. So I think let's think about buy now, pay later. This is a great example where you have a constellation of lawyers scaring the hell out of companies, saying, "Oh my God, you won't be able to. You don't know what to do. This is pay me, pay me." So what we try to do is be very clear, rather than having some hidden memo about how we interpret the law, we just made it public and made it clear this is how we would interpret the laws and regulations on the books today. And I think we wanted to make it public because we had done this multi-year study of the emergence of buy now, pay later. We're interested in making sure that it's clear we do see this as an important competitive offering to credit cards and other things. But again, we don't want to build on some legal arbitrage. We want it actually having some sense that there are certain laws that do apply to it, and we try to make that clear. But the bigger issue, I think, with you raise big tech companies, and I don't want to comment on Apple specifically. We have seen big tech companies since actually July of 2019 maybe, where Mark Zuckerberg and Sheryl Sandberg proposed their own currency called Libra. And you know, I was at the Federal Trade Commission there. It was a total nightmare. Central bankers, privacy regulators, financial regulators all saw how serious of an issue this was going to be. And I think we are continuing to be worried about big tech companies using their existing platform power to mint their own currency and essentially vertically integrate in ways that will totally stomp out a lot of innovation. We really want our payments ecosystem to have lots of rails, lots of players, lots of options. And I think when it comes to having a big tech company that can bully out other nascent players, that's something we're on the lookout for. We're also really on the lookout for the underlying business model. Are they looking to essentially engage in mass surveillance over your payments in order to use that and monetize it for personalized pricing, advertising, or their other business? So I think we are looking a lot at the convergence of payments and commerce and the extent to which a very big player could use that to shatter that wall between banking and commerce that we have seen as an important part of the US's financial system and why our financial system is so much better than others.
Well, so in terms of tech players and others and the payment space, obviously privacy is a big issue there. We're all still waiting and waiting and waiting for Congress to pass a federal privacy law. What is your push there, where you've talked about this issue at hearings with Financial Services Chair McHenry and others, but you know, really there's only so much the CFPB can do versus a federal mandate.
Yeah, it's interesting. So in much of the sectors of the economy, the state privacy laws are driving the agenda. So you're going to have a really tough situation where you may have all these state privacy laws that apply to some parts of the financial world, but then the biggest banks in the country don't have to follow it sometimes. So we do need real updates to financial privacy and anti-surveillance laws. We are in constant communication with both sides of the aisle about what we can do on financial privacy. And I think the reason the industry needs to advocate for it is that ultimately, one, you don't want to race to the bottom because you will be harmed as an entrepreneur and business leader if you are not monetizing in every way possible. But if we don't have that, we will lose a degree of trust. And I really worry we are just lurching toward a more Chinese-style orientation, WeChat Pay, Alipay, where we combine and just have two companies control all payments and have full information about all of us. And I think we actually want a more competitive market, interoperable, that there's more ways to pay without fear that you will be subjected to surveillance and personalized pricing and censorship.
Got it. And we're almost out of time, but I just want to ask you before we go, we just saw the Supreme Court come out with two major decisions that affect the regulatory system in the U.S. The rollback of the Chevron deference that, for decades, the courts basically deferred to regulatory agencies like yours to interpret laws. What is your sort of outlook for the longevity of, open banking rules or anything else that this CFPB does that can't be undone in the future, will not face major legal challenges now that it's sort of open game?
Yeah, I think it won't affect us too much. In many cases, we sort of have already priced that concept in from day one.
Yeah, the CFPB has been no stranger to legal challenges.
Most of our laws have express commands to us to do rulemaking. But you're right, I think doing rules obviously is taking much longer than people want. I mean, a lot of people in this community wanted us to be done years ago when it comes to open banking, but it does take more time because of this process. I do bizarrely think this is going to create more uncertainty. You're going to see a lot more things being litigated in the courts. There's going to be more split opinions and less finality to what the rules of the road are. So at the end of the day, I think it's not something that in the financial sector is going to be net positive for new entrants, maybe for some incumbents like who have a business model and want to kind of lobby their way out of accountability, maybe. But we'll see. I think we use a whole set of tools, and we will continue to keep doing, update the rules, update the guidance, and of course our law enforcement, including in the non-bank fintech sector, is going to be really important. And I appreciate everyone in this world who really comes to us and tells us where some of their companies in the sector are really harming consumers, because at the end of the day, fintech companies want to be able to be clear that they are not unregulated. And I think they benefit from having some fair oversight.
Yeah, well, you might have some companies coming up to you after this. So.
Well, I always do, yeah.
Thank you so much for being with us.
Thank you so much, yeah.
Please welcome Kenneth Lin, founder and CEO, Intuit Credit Karma, and welcome back to the stage Semafor General Manager and Global Head of Public Affairs, Bennett Richardson.
Thank you. So I brought a heavy hitter with me this time, Ken Lin, founder and CEO of Intuit Credit Karma. I have a ton to talk to you about. I want to make sure we fix everybody's credit scores, we fix the financial system. We've got big ambitions. I know you're a problem solver for this conversation. Want to get to the founder story, but first I just wanted to pick up on a couple things that Director Chopra talked about. He was talking about the need to look into lending and mortgages and really continue to ease access to those opportunities. You shared an amazing stat with me backstage. Credit Karma has distributed 30 billion free credit scores and free credit reports. Is that right?
That's right, over that. So first, thanks for having us here. But I think when you talk about fintech and when you talk about problem solving, I think that is a prime example. So back in 2007, when Credit Karma was formed, to the notion of gatekeepers, there were gatekeepers, right? Credit scores are one of the most important metrics of your financial health. And for the most part, you couldn't have access to it. So, we started a business in 2007 predicated on everyone should know their credit score, everyone should have access, we should make it completely free. And since then, we've provided over 30 billion free credit scores and reports to consumers, never charging any of them for any of the services on our platform. I think that's an important aspect of an example of what fintech can do in the industry.
100%. It seems almost obvious because it's so ubiquitous and so helpful today, but take us back to 2007. What inspired you to start a business around credit scores and credit reports? It seems like a intimidating, almost a black box to jump into as a founder.
Well, if you think about the space, right? So so just a little bit of my story is I've been always a little bit of a tinkerer and an entrepreneur. Back in 2006, there was a trend where people were starting to realize the significance and the importance of credit scores. But the business model at the time was that you would go to these, quote unquote, free credit scores. They literally had the name free in their domains. And they would enroll you in a credit monitoring service, and that would be the way that you access your credit score. And the perspective that we had was, well, this is just so important. How do we make it free? So our business model was, I think, straightforward. We said, well, we'll make it free to consumers. Banks are always looking for new customers, and banks are always looking for a new customer of a particular credit quality. So if we become the matchmaker in that space, if we give the credit score for free, if the banks are already paying for target customers, why don't we make that the business model? And 17 years later and 130, 140 million members and consumers later, we've built a business predicated on helping consumers understand their credit. But I would note that the key here is that when consumers are looking for credit scores, they're actually looking for credit, which is really the secret sauce. They're looking for financing. And that's where a lot of our innovation has really come into play, which is, I think, the first 5 years, we were certainly a free credit score provider. But since then, what we've really focused on is helping consumers get what they're looking for, which is lowest cost products, most certain products, most transparent pricing, the simplest products to find in the market. That's how we've really built our business and our brand.
Amazing. And I just want to take one step back there during those first 5 years. That ambition, that demand, I feel like became a lot more acute during the financial crisis and during that Great Recession right after that. I mean, what was your experience like? I guess that would have been year 3, basically, of Credit Karma. Like, what was that like navigating the Great Recession and adapting Credit Karma's offering to what so many people needed at that time?
Well, it's really interesting, right? Because we actually started in 07, we launched in 08, and the Great Recession was effectively 09, right, if you think about it. So I think very quickly, all financing dried up. All of the banks were on the verge of collapse, if you can remember. And that also made all VCs very squeamish about investing in a business like Credit Karma. But the good news is what we have always focused on is great financial hygiene. So we were always a very financially prudent company. We didn't spend a lot of money, but it helped us quite a bit in terms of getting through that. And on the other side of it, the things that we learned in terms of operating lean and really being focused on delivering for the product or the consumer, that's been a hallmark. I remember one point in time, it looked like there was going to be nobody who would give us our lifeline from a financing perspective. And I remember saying to the team, if we're going to go out, let's go out focused on the idea that we have brought credit scores to a lot of consumers and we operate in a way that we could be proud of even 10 years, 20 years down the line. And I think that has always been a hallmark of how we operated at Credit Karma. And to this day, 17 years later, I'm proud of the way we operate. We don't sell consumers' data. We've very much been focused on helping them get to a better place in their lives. That's
amazing. And as we were talking about the other day, there's almost an expectation that some of those things would happen, but you all have really safeguarded that, even as you've grown. And I just think that's as you bring us up to, Intuit Credit Karma today, not just credit scores and credit reports, doing so much to help your consumers and your customers really manage their entire financial lives and their financial pictures. We'd just love for you to talk us through a little bit of that journey, and especially Intuit Credit Karma today. Like, how do you think about helping your customers be more thoughtful and pragmatic about their finances?
Well, let me cite you a few stats, right? I mean, 77% of consumers are extremely anxious about their finances. 64% of consumers live paycheck to paycheck. I think 56% of consumers don't have $1,000 in savings for an emergency. And those numbers have gotten worse in the last 10, 15 years. And my note in this space is that while banks have become more profitable, while technology has created better underwriting models, AI has created more efficiency, machine learning has really squeezed the last, parts of margin out of the lending or into the business of lending. Consumers have been effectively left behind in that context. So what we focused on at Credit Karma is leveraging the same technology, but for the benefit of consumers. So let me give you a couple of examples, right? So today, if you were to apply for a loan product, your decisioning, your underwriting of whether you qualify or not is going to be dictated by, on the low end, maybe 100 different variables, on the high end, 1,000 different variables. Well, as a consumer, there's no absolute way you can determine whether or not you will be qualified for that loan. So what we've done at Credit Karma is we've taken the data that you have, that the banks have, and we said, let us create that same exact algorithm that the banks are using so that we can determine whether you're qualified before you apply for that loan. And that's a big deal and goes back to why consumers are looking for credit scores in the first place. But if you really think about this, this is maybe one of the only industries where you as a consumer are looking for a product and you actually don't know whether you can buy that product and you actually don't know whether what the pricing of that product is going to be until you apply. And when you think about that, that is crazy. That is crazy in 2014 when we have so much incredible technology around us. I think that is really the hallmark and the chart of what we're trying to do at Intuit, which is simplify this process for a vast majority of consumers. I mean, you know, the very privileged to have private bankers, but now we're in a space where technology, generative AI will allow every consumer to have a private tutor, a private banker to help them with all these things, and I think that is a very interesting future.
Amazing. No, you beat me to the punch there, and I feel like that piece is so important, that so many of these tools and these products that you all are building and bringing to your customers were previously kind of gate-kept if you had that private banker. Talk to us about AI at Intuit Credit Karma. It's not really new in financial services. It's not really new for you all. Like, there's been so much learning and prediction happening within your tools. But talk to us about how you're using AI and Gen AI today and how important you think that'll be to the future of finance writ large.
Absolutely. I mean, I think this is one of those transformative points. I'm not a big crypto person. I'm not a big metaverse person, but I am a big generative AI person. And I share that because I think this will be as big as the internet when you think about what it will do for the changing of lives. And if you talk about it outside of financial services, I mean, imagine a world where every student has a personal tutor who understands their deficiencies in math and understands how to cater the curriculum to them. Now, if you bring that model and that example over to financial services, one of the biggest challenges in this space is that there's a lot of generic advice out there. Pay your bills on time, don't take too much debt on. But there's no prescription. There is no sense of what should I as an individual do. And historically, it doesn't scale, right? You can be a private banker, you could give financial advice to a consumer if you're in the top 1% because you're able to generate enough revenue for the bank for them to hire somebody to actually look at that information and give you a prescription. But if you're not, generative AI in general, is actually the great equalizer because now we're in a situation where each person in a room gets a specific tailored advice to, well, you should pay down your credit card that has 70% utilization. You should cure this one late payment that is 60 days delinquent. You should consider having X, right? You should consider bringing down your DTI. Well, these are just some examples of how, one, that will be able to allow consumers to focus on understanding a very complicated market. But secondarily, I think one of the things that also is fundamentally important in helping the average consumer is making these things easy. There is so much friction in this space, whether it is building, just paying your bills, whether it is understanding, well, where should I go to go find 100 basis points less the fee or 100 basis points more of yield? Well, you may have that information, but the friction, and we can talk about 1033 later, the friction of doing these things actually keeps consumers from doing anything, right? So it's so complex. There's so much friction associated with it. I think this is the opportunity for technology to come into play to, one, help you understand what your options are, but more importantly, to do it for you. Because we are creatures of habit, human nature, it tends to err on the side of less friction and doing less. And I think that's where technology can help us get to a better place in our financial lives.
So you're saying we're lazy and AI is going to help us manage our finances. I like the sound of that. I mean,
well, I think it's true, right?
Yeah, absolutely.
We say that tongue in cheek, but we are all fundamentally lazy. I mean, we avoid friction almost always. And finances in general are so friction-full. And that's where I believe the confluence of technology, the confluence of data, but really change, the lives of a vast majority of consumers.
Absolutely. Well, and I feel like that's the dream and the ideal for not just you and Intuit Credit Karma, but with so many in fintech. Wanted to go back to 1033, and obviously you're here in Washington. We've got you wearing a tie for like once a year, which we appreciate.
Literally once a year.
I did not, because it's too hot out, but I appreciate you getting dressed up for all your meetings today. Obviously we just heard from Director Chopra, as you mentioned, 1033, top of mind, so important for this, like reaffirming that digital infrastructure that underpins so much of fintech and really all of fintech. Like, why is it not only important to that infrastructure, but how do you think about it as important to both the broader financial ecosystem and to your consumers?
Well, this is a known, dirty secret in the industry, which is, things like bill pay and things that keep you at a bank are there for a reason, right? And the interoperability, the lack of mobility of your accounts and your information is part of why, we tend to stay at the same banks. I mean, I have a phone in my pocket. For the first 10 years of having that phone, I never changed carriers. Why? Because I never wanted to change my phone number. But since, data mobility with your phone, portability with your phone number, I've probably changed carriers, 10 times. And I think a similar degree of what is great for competition, great for consumers, great for feature enhancements. That is really the benefit of having 1033 and really allowing consumers to move their data, move their relationships. Again, going back to this idea of friction. If I have to reset up every single of my accounts and I have to go and create 20, 30 minutes worth of friction associated with doing that, we tend not to do that. Even if it means saving an extra $500 a year, and we see it all the time. We know consumers, even if you're going to tell a consumer, you will save $500 a year, a lot of times consumers won't do it because there's a lot of work associated with it. I mean, for any homeowner in here, at various times in your life, you could refinance that mortgage and save $25, $50 a month. But I would bet dollars to donuts that a lot of people don't do that because the amount of work and having to have conversations on the phone, those things people do not want to do. And I think technology, again, will help us reduce the friction in this space. And that's why I'm so bullish on it. And that's why I think, consumers will be better off with more data portability, with more technology in the space. And, I think everything Director Chopra said about, well, you have to watch out. Absolutely, right? I mean, there is no, there will be some negative unintended consequences along with any technology. But fundamentally, if you think about the greater good here, I think that's a really important aspect to keep in mind.
I love it, absolutely. And that combination, less friction, empowered with more personalized solutions and recommendations from tools and companies like yours, it's a potent combination. We're almost out of time. I want to do a couple rapid fire questions for you. Magic wand, anything you would change about the fintech policy landscape in America? Just a couple words.
I think there has to be more space for innovation. I think sometimes if you hold the same standard, it should be risk-based, but at the end of the day, if you say you have to have the same obligations as a multi-trillion-dollar bank, I don't think you're going to see as much innovation as if you said, well, if you are a 20-person company trying something new, let's understand the risk and give you a different, framework.
Totally, I love it. And final question, you've been with Intuit Credit Karma for decades now. Why do you love working in fintech? What's kept you in this space?
Well, if you think about the opportunity and the mission, right, there is a chance to fundamentally change the lives of so many people. And I think that for most people, health and money are the two most important things. And we have an incredible platform. We have an incredible opportunity to make a difference. And that is compelling.
Amazing. I love it. Thank you so much, Kenneth, for being with us today. Thank you, everybody, for listening. And
Please welcome Jonathan McKernan, Director of the FDIC. Semafor Senior Editor Gina Chon returns to the stage.
So thank you, Director McKernan, for joining us. I wanted to get straight into the FDIC and kind of its philosophy when it comes to the fintech space and innovation. The agency, just famously known, maybe the one thing consumers know about it is the deposit insurance for bank accounts. And for years, the the sort of North Star for the agency has been to protect the deposit insurance fund. You know, we saw that even just in the last banking crisis with some of a few of the regional banks failing. I wanted to get your thoughts, given that backdrop. What does that mean for oversight, for allowing for innovation, especially for banks partnering with other fintech companies? How much room is there for that?
Yeah, no, it's a fantastic question in the sense that, right, the FDIC is known primarily for protecting deposit insurance fund, the DIF, right? That is central to our worldview, our psychology. Obviously, I won't speak for the FDIC. I'm just one guy on a 5-person board who, candidly, my job's a little weird. I vote and I complain a lot, right? I vote and I dissent and complain. But from my perspective, I mean, you got to start with the statute, right? Safety and soundness, consumer protection, financial stability. These are our mandates, right? But within that framework, it's incumbent upon us to have a regulatory framework that achieves those goals efficiently and fairly, right? And from an efficiency perspective, that's both like static, but also dynamic. And we've got to foster an innovative financial system to do that appropriately, right? Now, there's a balance there, but I think innovation is critical. And I wish, candidly, that we at the FDIC would say that more explicitly and actually make the case for innovation within the financial system.
Yeah, so what does that look like for the FDIC to be more explicit about that? Is it through sort of third-party risk management, where we have seen various enforcement cases on that front when banks partner with fintech firms? Is it would you ever want to see the FDIC even consider like a regulatory sandbox to sort of try out some things where banks can have some sort of pilot programs?
Yeah, step one is we just need to say innovation is important, right? And then make the case for explain why we think innovation is important. Step two, I think, some sort of engagement, enhanced engagement. We do some of that, right? I mean, it's shifted over time, the extent to which we engage with the market participants on this. There's always room, I think, to do more. One of the things that really echo with me from Director Chopra's comments is it's important that we make sure that this regulatory framework does not entrench the incumbents, right? Does not pose undue barriers to entry, unduly impose an impediment to innovation. I think regulatory sandboxes is one way to do this. I think, you mentioned the third-party risk management guidance. This is famously principle-based, right? It's risk-based, and it has to be, right? I don't think most of you all would want a one-size-fits-all approach to third-party risk management. That said, that guidance, at least as I read it, it's really kind of, I guess, tailored most to the services that a bank obtains, right? As opposed to working through a service provider or having a service provider that works on behalf of a bank. I think there may be opportunities for us to think about activity-specific guidance under this framework of third-party risk management that articulates with maybe greater clarity, hopefully greater clarity, ideally even some black and white rules of the road, how we think about certain sorts of bank partnerships, right? Because again, you want a principle-based third-party risk management framework, but when you have something that's principle-based, that empowers the lawyers, as Director Chopra suggested, to shake it down.
Sorry to all the lawyers, right? You're getting a little
well, and as a lawyer myself, right? But that lawyer shakedown is not something that we want as part of the framework, I think. And so if we can articulate, again, something activity-specific under that third-party risk management framework, I think that's a promising thing to explore.
Yeah. Well, and you mentioned entrenching the incumbents. We've seen the number of banks in the U.S. Shrink down, particularly among the medium and community-sized banks. How do you think technology and fintech partners can help some of those lenders compete? Is that something that the FDIC would encourage, especially as we see, just in the last banking crisis, J.P. Morgan got bigger, bought another bank, and we've seen actually that crisis helping them in a lot of ways.
Yeah, I think there's certainly a lot of potential for innovations to help reduce the barriers to entry, reduce the scale economies that tend to entrench some of our largest financial institutions. That's good for financial stability, that's good for safety and soundness, that's good for consumer protection. I think, more concretely, ways in which that can happen. some of these largest financial institutions have their dominant market position due to kind of legacy systems around payments and others that really are ripe, I think, for some dynamic, some creative destruction even, right? I think that is something that we really need to think about. How can we foster that, right? Consistent with our statutory mandate around safety and soundness, consumer protection, but in the payment space, for instance, there's a lot of opportunities there. And I think, there's tends to be a lot of focus on what innovation can do for the consumer, right? And I think that's important, but we shouldn't distract ourselves. We shouldn't forget that innovation can really help position the smaller institutions, the new institutions, to help better manage their risks, right? That's key from a financial system perspective, right? So to the extent innovation can enhance that risk management, I think that's something also we want to think about.
Got it. And we were just talking with Director Chopra about the Synapse bankruptcy case. Given that it also involves a bank that Evolve, which has deposit insurance, how do you see that case informing, what the agency should be thinking about when it comes to oversight, when it comes to their relationships with third parties, right, especially given, the way that Evolve just sort of cut off their partnership with Synapse, and, now all these customers are left stranding a bit. How are you seeing that situation?
Yeah, it's tough to talk about particular cases, especially as we're still early, I think, in the fact development. But what I will say is that particular issue, some of the other enforcement actions, I think it's important. It's going to be kind of basic, but it's amazing the extent to which, this is not actually practiced. It's not enough for a bank to have in their contract a provision that says that the partner is going to perform actions X, Y, and Z. The bank has to actually monitor that the institution, the partner, is performing steps X, Y, and Z, and then they have to have the risk management expertise within the bank to kind of think more globally, big picture. Okay, well, we've checked the box on X, Y, and Z. What else are we missing here? Again, going back to the principle-based approach, and that doesn't happen a lot, candidly, right? The monitoring component, it's not just about the diligence process, the onboarding process. It's not just about what you have in your contract. You actually have to monitor to make sure that your partner is performing its obligations on the contract.
And for that case and others, the FDIC has been sort of on a campaign about deposit insurance and sort of language around that. How much can you really say that that is part of your offering? Obviously, it's for specific FDIC-insured banks, and so others that don't have that maybe shouldn't use that language. How is that campaign going? Do you see any big enforcement cases coming out of that, or is it more just sort of a guidance messaging proposition for now?
I just say I commend the chairman for really making an issue of this really candidly a problem, right? And helping to provide some clarity in this space. But it's not just about signs, right? There's an education campaign and probably more work to do here. I don't want this issue to unduly impede innovation or help entrench the incumbents, but some have taken advantage of the deposit insurance issues, the logo, in ways that have created some customer confusion to their detriment.
Yeah, and so do you see actual cases coming out of this, possibly?
Yeah, it's hard to comment on specifics, but I hope we are vigorously enforcing our rules in this space.
Yeah, and in terms of the regulatory framework, we had Director Chopra up here, whose mandate for the CFPB is a bit large in terms of sort of the companies that are covered. The FDIC is obviously more specifically, squarely in the bank space. Do you feel like there are sort of cracks in the system as we look at financial innovation and which regulators cover what? The Financial Stability Oversight Council, which the FDIC is a part of, and so is the CFPB, was supposed to be the one that is, looking at some of these cracks and not letting things fall through the loopholes, but we haven't really seen much out of them either. What do you think of the way the system is set up right now?
it's interesting. I don't think if you had a blank sheet of paper, you would sketch out the regulatory framework we have now. You
wouldn't have 5 different banking agencies.
But I do think it works pretty well for the American system, right? Like the FDIC is, it's got mostly community banks, not a whole lot of large institutions. I think that has been really great in putting someone on the front line, especially because we protect the deposit insurance fund, to really campaign against what I call bailout culture, right? Some countries put all this under the central bank, and I'm glad we don't, right? That just creates some conflicts that we don't have in the same way in the United States. There's always, opportunities to enhance the regulatory framework. I don't know necessarily in the innovation space, but I did a lot of work on housing finance GSEs, right? Like there's opportunities there, I think. Questions obviously for Congress, but financial system is dynamic, right? And so we always need to be assessing the extent to which new activities might not be appropriately regulated within the regulatory framework.
Yeah. And how about the FDIC's work with state regulators, especially because for a lot of the fintech space, that's kind of how a lot of them have licenses, whether it is around payments or sort of money transfer approvals. That also creates its own patchwork system. How does the FDIC work with some of the state regulators when it comes to especially bank enforcement, but also third-party risk management?
It's probably varied over time. There's always opportunities to better enhance that partnership. And I really like that aspect of the system, especially for community banks. It seems to work well in my view.
Yeah, that they have that sort of local touch point.
Right.
In sort of our last remaining moments, I did want to ask you about the FDIC itself, which is, as a lot of us know, has been through a lot of turmoil. We've seen Chair Gruenberg say he will step down when his replacement is confirmed. But still a lot of lingering questions about accountability, about the toxic work culture there. How has that affected the FDIC as a regulator itself in terms of its own credibility as it's overseeing these banks?
Yeah, I co-chaired with Comptroller Sue, our committee that oversaw that investigation, and the findings there are obviously shocking. The path forward, I think, is challenging. We really need a fresh start at the top to credibly execute on that. And then, and if we don't do that, I think it really will challenge our ability to execute on the safety and soundness, consumer protection, financial stability mission. You see it already in the employee surveys, right? We were at the top for a bit. Now we're second from last in our group. You can see it in our Inspector General has flagged human resource issues, and particularly retention. It's one of our biggest strategic risks. These issues are going to compound if we don't fix our very real and very serious, shocking cultural issues.
Yeah. And what about at the board level, which you sit on? Has it impeded work on, there's a host of rulemakings that are still on the table? Has this issue sort of paralyzed the board at all from moving forward on any of those measures?
We had a constructive, productive board meeting recently last month, and I think we'll have more. So I don't think it's impeded our work, at least yet at the board level. But I will say, and I've said this many times, I think it's really important that the full board step up during this interim period while we're waiting to confirm a new chair. We have to have the full board engaged, ideally on a nonpartisan basis, to execute on our culture transformation. And I would just, really pay my respects and commend Director Chopra, who's just here. He's also on the FDIC board. Director Sue for the constructive spirit in which we've been working on these issues. It's just so pressing. It's existential for the agency that we move very quickly to get these done.
Yeah. And what are your hopes that a replacement will be in place soon, just given, the Senate's a bit preoccupied with some other things. I don't know how quickly they can get to a nominee.
Yeah, I'll just echo, we really need that fresh start at the FDIC.
Yeah, okay. Thank you so much for your time.
Thank you, everyone.
Please welcome Penny Lee, President and CEO of the Financial Technology Association.
Good morning, everybody, and thank you for braving the heat and NATO summit and road closures and everything to be with us here today. My name is Penny Lee, President and CEO of the Financial Technology Association. We are thrilled to partner here with Semafor to bring you today's event. We represent leaders in the financial technology industry, including many of the companies that you have seen on stage today and will continue throughout the day this morning. These are the companies that are powering our digital financial infrastructure and expanding access to vital services. And as our lives become more digital, it is critical that we modernize our financial services and regulations so more people can benefit from these responsible innovations. And as you've heard today from some of the speakers already, especially from the regulator perspective, how can we create that right balance? How can we create the balance needed for safety and soundness while allowing innovation to thrive and to continue? So earlier this week, as Bennett alluded to and others, we announced, and I have a copy on all your seats, the Future of Finance Policy Agenda. We urge you to take a look as it lays out the map, the blueprint of how we think the U.S. regulatory system, some policies that we would encourage policymakers to adopt, to be able to put the U.S. On a pathway for innovation, on a way that allows these new financial technologies to be able to thrive. As we know, 8 out of 10 Americans right now use a financial digital product, and we want to ensure that that innovation continues to flourish. And so we encourage you to take a look, read it, and we will be happy to engage with you in a variety of different ways. So today, right now, I get to introduce 2 more wonderful FTA members who are going to come in a dialogue, and that is Jen Taylor, President of Plaid, who will be in conversation with Jennifer Cooperman, Chief Corporate Officer of Chime.
Hello, Jennifer. How are you? I'm excellent. Thank you. How are you?
Thanks, you guys, for being here, and thanks to Semafor and FTA for hosting us. 2 Jennifers in FinTech. Always 2 Jennifers, usually 27 Jennifers, as they say. We are not FinTech lifers, though.
No.
So would you say that you're not a FinTech lifer? Tech lifer?
I'm a tech lifer. I'm 5 months into my journey in FinTech. If I had known how interesting and exciting and fun FinTech was, I would have done it earlier.
Years ago. Okay, I feel similarly. It's a good space to be, and hearing the speakers earlier today makes me even more excited for the things that we can do.
Yeah, the opportunity to have impact.
Totally.
Yeah.
All right, so you, as you mentioned, you're 5 months into a new job at Plaid as president of the company. You're hot off your customer conference, it sounds like. So tell us what's going on. What are you thinking about? What are you learning about? What's happening?
Yeah. So I have to say, there's no better way to start a new job than diving in and spending time with your customers and consumers, because it's those are really the true north, right? That's what we're here for. And so it was a wonderful opportunity and privilege to have time to talk with customers and consumers in the conversations we had. For consumers, choice and control. It comes back to choice and control time and time again, and our responsibility to unlock that in ways that are easy and safe for them and for the services they rely on. But just to back up for a second, because I know what Plaid is, but other people may not.
Great.
So, at Plaid, we power the digital financial technology ecosystem by providing the infrastructure that enables services and individuals to connect their financial accounts to digital finance. So we provide the services, for example, that enable you to connect your bank account to Venmo in a simple and easy way. And so for us, these kinds of conversations and really diving into that journey with consumers is so fun.
And just for background, Chime, for those of you who don't know, is the #1 most loved banking app that provides everyday kind of basic banking services that are free, simple, transparent to everyday consumers. And everyday consumers are the 60+% of Americans who live paycheck to paycheck or are making under $100,000. So just so you know who we are. But you've spent, as you said earlier, you've spent the majority of your career in tech. So now talk about this transition to fintech, and how does it apply?
Yeah. So I've been working in tech pretty much my entire career, but most recently I was the chief product officer at Cloudflare, where we focus on building a network and creating connectivity and security for cloud services. And it's been phenomenal to sort of roll that forward into fintech, because it feels to me there are kind of two things I'm able to bring with me. The first is just the importance of building out and being a steward of that underlying network, that connectivity. But then the other is really understanding and how important and how dynamic security is in this environment. And so it's been phenomenal to be able to bring some of those perspectives into the conversations I'm having now. But man, I'm learning a lot too.
And the security piece is so I know we'll talk about that, but it just feels like it's the underpinning of all of it for us to get it right, regardless of what company you're in. I also learned that you recently released, maybe as a part of your customer conference, your survey called the Fintech Effect, which I now need to get my hands on, which looks at how consumers are benefiting and using financial services and financial tools. So can you share a little bit of the insights that you guys learned from that? And does that give you an insight into kind of the state of fintech generally, or state of consumer?
Yeah, I have to say, reading that report, especially as I'm just sort of getting started here at Plaid, was so exciting, right? Because it's just, first and foremost, we came out with the sentiment that fintech is here, and it's here to stay. If you just look at the rate of adoption and use of fintech applications by consumers, it's increasingly growing. Today at Plaid, 8 in 10 Americans engage with and connect to at least one Plaid-powered service in their daily lives. So
8 of 10.
8 of 10. So it just gives you a sense of sort of what that adoption is. And so it's not surprising then that consumer use of these services is also growing as we see it. And the thing that was really, really meaningful to me was seeing that the adoption of these services is really starting to sort of level out, or sort of become more equitable across different socioeconomic and demographic groups. That you're seeing people from all walks of life really embrace fintech for how they engage, whether it's managing your stock portfolio or using a fintech app to connect with and apply for affordable housing. And so it's been phenomenal to me to sort of see that sort of depth of integration. But then I think the final thing, and it kind of ties to what we're just talking about, was the overwhelming sentiment of growing trust in fintechs and the security of those systems. And that is not something, to the conversation we're just having, that I take lightly, right? Like that is something that is a responsibility and an obligation for us as technologists to continue to invest in and provide those solutions.
Do you, I just want to ask a question about the demographic. So we see a similar thing at Chime from a demographic standpoint. So more and more usage of our products, whether it's a younger demographic or people in banking deserts not close to a physical infrastructure of a bank, or there's so many different versions thereof, and so that's where the proliferation of fintech is coming, and done in a responsible way can actually change the lives of those individuals and change the industry. And I think it's the cumulative effect of these companies that are doing that. So I'm very glad to hear you say that.
Well, and there's also a generational component too.
True.
I mean, we used to use checks, remember?
No, I have no idea what you're talking about.
Neither does my 20-year-old son.
I know, isn't it amazing?
He's like called me from college. He's like, I have to put a deposit down on an apartment. And I'm like, great. He's like, I used Plaid to file the application. I'm like, right on. And he's like, but I have to write a check to put the deposit down.
He had no checks.
He's like, I don't know where my checks are. And I'm like, well, here, this is right there. And he's like, how do you write a check? And I'm like,
oh my God.
I'm like, there's a YouTube. Just check YouTube. There's a video.
Oh my God.
Yeah, it's crazy.
It's amazing, but it is. I mean, you're right. Generationally, we're moving away from it, so we better get it right. Is kind of more the piece. Director Chopra talked about, and actually everybody on stage has talked about open banking.
Yes.
and the importance of 1033 rule. Can you talk a little bit about that and how it relates to Plaid and what you guys are doing?
Yeah, we're really excited about open banking, and we're really excited about 1033 becoming policy. We've been advocates of open banking since our inception. At the core of it, what we believe open banking is striving to do is to give consumers more control and choice over how they manage their financial lives, and to create an ecosystem around them that has a level of responsibility and accountability to that. And so we're really excited to see it come into law. We're excited to see things like API standards and things like that, things that I grew up with in my prior roles in the web standards community, really coming to the forefront to enable that connectivity in a way that is more seamless and will allow us to continue to expand the universe of services that can connect. So whether I'm connecting to my bank or whatever, but we think open banking is like just the beginning. Like for us, I think the hope is that digital banking is the first step towards open banking is the first step towards open finance. That like we fundamentally believe, as we were just talking about, that more and more of consumers' financial lives and the financial interactions that they're going to have are going to come online. One of the things we talk about at Plaid is that we do fundamentally believe that every company will become a fintech company.
Yeah.
But at the end of the day, what does that mean? It means they're integrating digital banking services into their platform to enable their customers to transact more securely and more easily. And so roll that forward, just as you were mentioning a moment ago, of sort of that banking deserts, affordable housing, all of these things are in the future, and I'm excited about what could be possible with open finance as well.
Yeah, I totally agree with that. And so you guys are pushing beyond open banking to get to this open finance concept in the not so far future, I think you would say. Director Chopra said at the beginning, he said something like, a lot of fintech companies are putting the tech on the fin in order to drive up valuations or whatever else. That may be true, but I think for our two companies and for a lot of the fintechs out there, it's really about how do you responsibly add that technology element to financial services to get to the democratization of any kind of financial services. Less about the company and its valuation, more about like what it allows for a consumer and for the industry.
And that's work that we have to do together, right?
I agree.
And I come back to my point earlier around security. Like security is a team sport. And it's something that we have to kind of come together and work together on. At Plaid, we have a variety of different services. We have digital identity verification. We have an anti-fraud consortium that makes it possible for people to share these insights. We leverage the signals that we see across our network to help identify potentially fraudulent transactions. But that is a small sliver and needs to be done in concert with a broader community. And so again, I pick up that mantle around security to build that trust and to really be stewards of the customer.
And then I guess piling on to that, what do you see as the financial services industry's roles in ensuring safety and security overall? So like, do we play an industry role? Is that us as companies? How do you see that evolving?
I mean, I think it's all hands on deck.
Yeah.
Honestly, yes, that's it. And this is where I, again, have been excited about the work that we've seen in the open banking space, because you really have seen the opportunity for technologists, for financial institutions, for policymakers, for consumers to come around the table and have a robust dialogue of what is the problem we're trying to solve together here, and how do we roll up our sleeves?
Yeah, and it goes back to all the years in tech that you've had. It's not net new.
Yeah. But you've been very gracious in giving me a chance to talk about Plaid, but I want to spend a couple minutes here talking about Chime. Because the work that you guys do.
I'm the moderator.
Your name is Jennifer.
Yes, exactly.
There you go. Tell us a little bit more about kind of how you at Chime are thinking about open banking and how you think it may change the ecosystem for you. What opportunities does it create?
I think, good question. So Chime was created right after the financial crisis, and it was our two founders, Chris Britt and Ryan King, had this aha that traditional banking was not well serving everyday Americans, and the punitive fees and some of the traditional ways of operating was never going to serve it. It was serving people with higher balances and not people living paycheck to paycheck. So that was the origin of the mission of how do we provide basic, simple, free financial services. If you think about open banking and our partnership with Plaid, I don't know that we said that. Chime is a customer of Plaid. consumer-controlled data allows us to offer these financial products, free, simple, transparent, et cetera, in a broader sense that are not limited by the current banking limitations. And even Director Chopra earlier was talking about credit scoring.
Right.
So credit scoring has been like the traditional way that you like look at somebody's financial health and then offer them the thing, or not offer them the thing, as the case may be. And now with open banking, you are able to, in a very responsible and more personalized way, with the control of the consumer, give people access to more financial services that they need, that allows them to make progress in their financial lives and utilize these products responsibly. And it is incumbent on us to make sure that it is responsible and that we're doing all the right things in the right regulatory frameworks. But that's what empowers a consumer and then changes an industry. So we are in lockstep in terms of open banking, being positive and doing it in the right way, and being one of the agents of change in that. So I agreed with what Chopra was saying.
It is such a privilege to partner with you. I love the collaboration between the two organizations. I think it's such a great, you guys have just been such a great catalyst for the work that we've done in our roadmap and really pushing us forward.
Likewise, thank you. So Penny was just up here talking about the Future of Finance Agenda and the policy recommendations that they have in the booklet that they left all of us. What do you hope to see Washington make in terms of how we make that vision a reality from a policy standpoint?
I mean, I talked about FinTech is here. I think open banking, hopefully, is here, and I'm excited about that policy. I think there's more that we can do. I think, again, kind of coming back to the notion of, I think the future here is really forged by bringing together these diverse groups of people, technologists, policymakers, customers, financial institutions, consumers, and really enabling us to think about how do we continue to innovate, but create the right balance for the consumer, and again, just continue to hold the consumer at the forefront, and that importance of choice and control.
I agree with that. To that end, since we have 56 seconds left, Bennett said we end on the quick hit. So why are you in FinTech, and what do you want to leave the audience with? What should they know?
I'm in FinTech because I want to make the world a better place. I want to increase access for everyone to the financial resources they need to build and scale the lives that they want to have. I believe it's our responsibility as technologists to hold those customers at the center of what we do, those consumers, and really sort of continue to innovate for them. And that's why I'm here. You?
I think ditto. Can I say that?
Totally. Totally.
It's the millions of people that we serve, that their lives are changing every day as we put out products and services that are responsible, and we partner with people like Plaid, and that's why we come to work every day. And if I were going to leave the audience with something, try out the products, like be a FinTech user to kind of better understand it. Chime, Plaid, whatever. Any of the companies up here today, I think it really does give all of us a sense, like we could sit up here and talk about policy and we can talk about all these things, but I think being a user of the products really does help all of us get a better perspective. So it says 0-0.
0-0, here we are.
You're awesome. Thank you so much, Jen. It was great to meet you. It was a pleasure. Thanks.
Please welcome remotely Guillermo Horn, Meta's head of WhatsApp for strategic markets. Gina Chan returns to the stage.
Hi, Guillermo. Thank you so much for joining us. How's the weather in Brazil, since we're all just talking about the weather here?
I'm in São Paulo, and it's very cold today, very cold.
Oh, I wish I was there then. Well, I was really interested in talking to you because we'd love to get sort of a global perspective on the FinTech space, especially because in a lot of other parts of the world, it's actually quite more advanced than it is here in the United States in terms of what people can and cannot do. And I wanted to look at Brazil in particular, because that is a place where WhatsApp has been expanding its services, moving from sort of peer-to-peer payments to now businesses. Can you just talk a little bit about that expansion and the regulatory framework that was needed and approvals that were needed to get to that place?
Yes, sure. So Brazil has a very much sophisticated market in financial services. We have, for instance, fast payments for a long time, almost 20 years here. We have now a new regulation on fast payments and a new product which is called PIX. But we have already fast payments for a long time. We have open finance regulation. It started as an open banking regulation 4 years ago, but then it changed to open finance as it already includes investments, insurance. So we are really, I think, ahead of most countries in regulation. The central bank here is fostering innovation and competition all the time. So I think we are in a very much sophisticated market, and WhatsApp is used by almost everybody here in Brazil, and not just for personal use, but also for business. So it's really common to do everything through WhatsApp here, to buy things, to transact with banks, for instance. Banks are a heavy user of WhatsApp here in Brazil. So they have like more than 100 use cases on using WhatsApp. You can open an account, you can apply for a loan, you can change your credit card limit through WhatsApp. You do everything through WhatsApp. We have even now a Fintech which does not have a website and an app. They are just on WhatsApp. They do everything through WhatsApp. So when we join the strength of WhatsApp here in the country and the sophisticated financial market, it is very powerful. It is very convenient for the user.
So what has that meant for consumers there and businesses? Because, you know, here, even just for me, I have, you know, my Venmo app, I have my bank app, I have my iMessage, you know, everything is sort of separated into its own ecosystems. What has that opened up for people in Brazil to be able to do everything within one app?
It's very convenient because WhatsApp is opened in the hands of everybody all the time. We use that a lot, every day, all the time. And so we are already logged in the app. So I would say that it's like obvious for any business to do transactions through WhatsApp, to do their marketing campaigns through WhatsApp, to do business through WhatsApp. So now we see business doing things through WhatsApp in all stages of the journey. So they reach out to customers for awareness. They do the purchases through WhatsApp, post sales, customer service, everything through WhatsApp. So in all stages, we see businesses doing business through WhatsApp. So it's like something really natural for all businesses here.
Yeah, and you mentioned the central bank's role there, and you know WhatsApp had to get approval for some of these services. Where do you see that going next? What does that open the app up to in terms of what other services you can offer?
Yeah, this is a very good question. So we applied 3 years ago for peer-to-peer transactions. It's now working. Last year, we started doing payment to businesses. And now at this moment, we are doing an integration with the official fast payment regulation, which is PIX here in Brazil. So we are now doing this integration, which is something that people in general use all the time, this PIX transactions. So it's like 70% of transactions are going through PIX. And now we are integrating WhatsApp and PIX. So this is our next step to finish this integration. This will take a few months, maybe by the end of the year, we'll be ready with the whole integration.
Yeah. And what was the concerns, excuse me, that you had to overcome, whether it was the central bank or working with other banks themselves? You partner with one of the oldest banks there, Itaú. It's like, you know, a JP Morgan here or a Citi. Because one of the concerns here is if you have too permissive of an environment, you're going to increase risks in the system. You know, customers could be caught out. You know, we were just talking about a case here where customers don't have access to millions and millions of dollars in total in accounts because of a bankruptcy case that involved some fintech players along with traditional banks. What are the concerns that you had to sort of address to get to this point?
I think the market here is maybe more concentrated than in other parts of the world. So we have 5 big banks here that they have a big market share in credit, in investments, in payments. So I think it is not the best thing in terms of competition, but it is very good in terms of having a solid market and having trust from the users. So generally, the users trust a lot these big banks, and they are very good partners for us. So for instance, you mentioned Itaú. Itaú is one of our largest clients, and not just a client, but they are a good partner for us as they do a lot of things through WhatsApp. Itaú, for instance, had a bank in Argentina. They sold this bank, but they had this bank there, and in Argentina they didn't have an app. They were just doing everything through WhatsApp. Since opening account and doing all the transactions. So this is a good example.
Yeah. And how does that compare to regulators in other parts of the world? And what does that mean for financial innovation? Because, you know, we had Director Chopra from the CFPB here talk about Meta's experiment with its own currency on Libra, and obviously there was a lot of regulatory pushback here. Do you see Brazil having, you know, and other places like India where you've also expanded in the payment space, that being beneficial in the end, obviously, compared to what the regulatory system is like here or in other parts of the world?
Yeah, of course, regulators, they need to care about the system as a whole and the stability of the system, but they are generally also looking for financial inclusion. And WhatsApp is very much inclusive. So for instance, you can, people that do not know how to read and write, they can send audio messages through WhatsApp, and they can communicate with their friends and families through WhatsApp. So in general, WhatsApp gives a lot of access to a lot of people in terms of communication. And the same thing happens with finance. So WhatsApp can be a very interesting tool to help on financial inclusion. And generally, regulators are very much aware of that and understand that. So we have a very good relationship with regulators in India, as you mentioned, because of that, because financial inclusion is a big challenge there. And the same thing happens in other countries.
Yeah. And in terms of worries about fraud or other misdeeds, particularly as you get more into the payment space and consumers are worried about AI, deepfakes, people impersonating you and being more successful at that, how are you looking at that in terms of protections within the app and meeting compliance standards around it?
This is always a concern, I think, for all financial players. Fraud is a concern, and in some countries it's a bigger concern. But I think we've been doing a great job together with the whole ecosystem. So we have partnerships with telcos, companies, with banks, with the regulators, and we've been investing a lot in security. We also, as we are built with the privacy concept, which is all the messages are encrypted, end-to-end encrypted, and privacy is something very much important for us. Is our I think main concept in terms of security. I think they are very much related, and that's why we are having success in this area.
So in terms of privacy, some of your sister brands may not be as known for having high standards in that space, but obviously with WhatsApp, it's become a critical selling point of having these encrypted messages and people not being able to access them. What is WhatsApp's approach when it comes to government requests for access to messages? Is that sort of a no-go? Is it a case by case according to local laws?
No, it is a no-go. It's a principle for WhatsApp. Privacy is our main principle, and the messages are all encrypted, and we have no access to that. So it's even a technological question. Of course, it's we can't do anything about that, and it's our main principle in terms of privacy.
So you're facing a critical situation in India related to this, where the government is looking at traceability and wanting that to be an option. WhatsApp has threatened to even leave the country where it has hundreds of millions of users. How do you see that playing out, and is that just a bluff? Would you really give up hundreds of millions of users because of this traceability request?
Yes, we will if this is the case. As I said, this is something that we do not negotiate, and unfortunately, in some democracies, we see people questioning, arguing about that. But this is our main principle, as I said.
Yeah. So if they stick to that, we would see WhatsApp essentially shut down there. Yeah.
Unfortunately.
Okay, got it. Well, thank you so much for your time, and I hope it stays cool there.
Thank you. Bye.
Please welcome Matt Oppenheimer, co-founder and CEO Remitly. Returning to the stage is Semafor General Manager and Global Head of Public Affairs, Bennett Richardson.
We're back. another amazing founder and CEO with me this time, folks. Matt Oppenheimer from Remitly. Thank you for making the trip all the way from Seattle. Not quite as beautiful and cool as Seattle is most of the time, but appreciate you being here.
Thanks for having me.
Of course, you got a necktie on for us and everything. Let's get straight to it, and I want to talk about your story founding the company. But for any, I have to play the voice of the audience sometimes, and just to ask maybe the obvious question, tell us about remittances.
Yeah.
There's a lot of words in fintech, right? Payments, transfers, remittances. Like what is that focus area for Remitly? Like what makes, and just for any super novices in the room, like what's the difference between a remittance, a payment, a transfer, all these other things?
Yeah, it's a good question. Remittances are traditionally defined as folks who are sending money from largely what the World Bank defines as middle or high income countries to low and middle income countries. But they're increasingly, a cross-border payment is a cross-border payment. And so while some of our largest markets are folks sending money from the US, Europe, Australia, et cetera, to Mexico, India, Philippines, we operate now in 170 countries, and we're making international payments. By digitizing it, we're significantly bringing down the cost and making that process much easier, which is super important given the criticality of remittances.
Totally. Well, and it's amazing to see the impact that you all have had in all of those 170 countries. But take us back, like, why did you start Remitly? Like, how did you come upon this, market opportunity?
Yeah, I come from a family of entrepreneurs, so I always knew I wanted to start a business. I started a nonprofit before I started Remitly, and I was looking for a problem that would really make a positive impact on the world. And I took the road less traveled to do that. So I've traveled to close to 100 countries. I lived and worked on 3 continents. And most poignantly, when I was living in Nairobi, Kenya, I saw, a lot of my Kenyan friends who received remittances. There was a poignant moment of one of my friends with her sister's Bank of America debit card going to an ATM. And the way she got money is she had her sister's Bank of America debit card. And the contrast between that and M-Pesa, which kind of, you were hearing about Pix, but M-Pesa is a mobile wallet in Kenya that was transforming domestic financial services. And seeing the experience a lot of my friends with remittances, I was like, there has to be a better way. And that started the journey about 14 years ago now to build Remitly.
Amazing. During that journey, 14 years is obviously is a founder story for you. Obviously, lots of up and downs building a company for that long. Was there a light bulb moment or a real product market fit moment in those early years where you feel like you really knew you were onto something building Remitly?
Yeah. I would say at the beginning, some of the light bulb moments of the problem, and I'm a big fan, by the way, of falling in love with a problem that an entrepreneur wants to solve, and then being flexible on the solution. So the problem was clear as day, being in Kenya, and then looking at some of the World Bank data, you see that remittances are like multiples larger than things like foreign aid, and historically, 6 to 8% has been taken in fees. So the problem was always clear. The solution, there were some pivots. In the early days, because of some of the things we've talked about today, it is hard to build an international remittance, an international payments company. And so we said first, hey, why don't we kind of think about how to build like a search engine for remittances and not do the actual money transmission because of all the complexity. That business model didn't work. So the aha moment was once we actually did pivot to being the money transmitter, and this is all within the first 6 months of the business. We started just with the US to the Philippines, and we started ramping up some marketing on some channels like TFC, the Filipino channel, which you can subscribe to in the US. And we just really started to see not only new customers come in, but the repeat usage continue, and we knew we were onto something.
Amazing. What made you start in the Philippines? Like, why did that market stand out above all others?
Yeah. Now we have a whole expansion team that
totally.
Has a whole
you've got so many markets too.
I probably have this old spreadsheet that I was looking at where were the fees high, where was it digitized, or the customers were ready to use a digital device. So back 14 years ago, some of the markets in Latin America, while expensive, the adoption curve of using a smartphone to link your debit card and identity to, it wasn't as trusted at the time. So it was fee, it was digitization/trust, it was the size of the market. There's 10% of GDP in the Philippines. So 1 out of every $10 earned in the Philippines comes from remittances.
That's amazing.
As a society. So it's a very large market, all those things, and it was a great first market for us. We focused just on that for the first couple of years.
Love it. And I think building trust is so important to you and to your customers in all these hundreds of countries, and something that we've talked about a bit. you obviously attacked speed and price and just built a superior competitor to the alternatives. But that's not enough when you're moving money around the world. Like, we'd just love to hear your thoughts about that journey. But gosh, we're better at all of these things than a lot of our established competitors. But how are we building trust along the way so that people actually want to trust you with their money?
Yeah, so that was the other aha. In the early days, I thought it was about speed, about price. Those things matter, but they matter under the umbrella of trust. And I think with consumer fintech, that is often overlooked. And there's so many poignant stories and moments. I mean, one is as recent as like last week. I was talking to a customer, and because we've gotten to enough scale in the Philippines, going to that example, and because not only are we digitizing so that customer doesn't have to go into a physical cash location, but also on the receive side, there's a mobile wallet called Gcash that a lot of folks receive funds into as opposed to getting cash pickup. That means we're taking so many costs out of the system. But what's interesting is I was talking to this customer, Levy, and Levy said, she was almost skeptical because the price was so good. She was like, how are you building a sustainable business? How are you doing this? And so it was this, again, reminder, and there's hundreds of stories like that, to where you've got to have a product that is trusted first and foremost, and that means operating within the regulatory framework. It means actually having a reliable service. 90+% of our transactions are delivered in less than an hour. Those kind of things are really hard to deliver. And then once you deliver those things, you can offer a lower cost product, but it goes in that order in terms of how customers think about which remittance service to use.
Yeah, absolutely. And it's a pretty enviable TAM, as it were, right? Do I have this right? 1 billion people around the world, or roughly 1 in 7, are sending or receiving remittances. I mean, that's just such an amazing market and such a huge space for innovation. And curious how you think about this. I mean, you've obviously had to be involved not just internationally, but also state by state here in the US in terms of understanding and shaping the policy environment for this future of remittances. Like, that must have been extremely important to you in this journey. I'd just love to hear how you think about that regulatory environment and how important is a stable policy environment to building a company and an impact like yours?
Yeah, I think that so I came from Barclays Bank before I started the business. That's who I was working for in Kenya. And because I came from banking, and because the area we're in is less like crypto where there might be gray area, we are a money transmitter, like no doubt about it. And so we leaned into that regulatory work in the early days because it's part of building and maintaining trust. So we're regulated in 48 states. Any state that has a money transmission law, we are overseen by the CFPB, by FinCEN, and that's just in the US, let alone as I mentioned, we're in 170 countries now. And I think that operating within that framework is critical to build and maintain trust with customers. And we've seen that from the start. I mean, we were talking a little bit earlier. In the early days, this is before I had family, kids, it was easier to travel a lot. But I went to Springfield, Illinois. I went to all these states to meet with the regulators. And a lot of the regulators at that time were like, companies don't do that as often when they're getting like pre-product market fit. But we always saw it as something that I think is critical to our success.
Yeah, well, it's super important. And it's interesting to see that through line of trust for you, right? I mean, you were building trust with customers almost before you needed it, building trust with regulators before you needed it, and especially state by state.
Yeah.
So important. I want to just ask you one final question on the kind of product founder side of things before we switch gears to Washington and policy a little bit more deeply. Innovation is obviously crucial in terms of growing the business, serving the customer, but it's a precarious balance. You don't want to over-innovate to a point where you jeopardize the deep trust that you've built in so many of these different countries. Like, how do you balance that? How do you drive innovation while still maintaining your, really authentic obsession with maintaining that like trust, safety for your customers? What does that balance look like for you?
Yeah. I think within a company, I think that there's ways to innovate that have no risk of eroding trust with customers. And so internally, I think that is something that we can do in parallel, and they're not mutually exclusive. I do think in a regulatory environment, it's important to have a risk-based approach because, as earlier speakers have said, it's a very different scenario for an early stage startup than it is for an incredibly large money transmitter or bank, and there should be risk-based approaches to that. And so there are improvements we can continue to make in that space, but I think it is more of a regulatory question and taking a risk-based approach that's most important.
Definitely. And I want to talk a little bit about your role in this financial ecosystem, because it's a unique one. I mean, in addition to providing this alternative to traditional remittance providers, I mean, there's so many middlemen. I mean, you all are partnering with hundreds, if not thousands, of banks to make that happen, as well as with local banks and community banks. Like, how is building that ecosystem and infrastructure around, like, how did that come together? Like, how big of a focus was that of yours as a founder, building that massive network around Remitly?
Yeah, it is a whole. So we, if you look, last year we sent about $40 billion through our system, and customers can send it between 170 countries, but billions of bank accounts, hundreds of millions of mobile wallets, hundreds of thousands of cash pickup locations. Building out that network, to your point, takes a lot of partnerships. So you've got to have the right, again, kind of foundation from a regulatory and trust standpoint, not only for our customers, but with our banking partners. And then within those banking relationships, it has been critical from day one, because if you don't get that right, you can't get the 90+% of transactions delivered in less than an hour. And we still haven't gotten it perfect. 90% still 90%. But you see how that's getting better every day, and that is because of these relationships and partnerships that we have around the globe that enable us to not only have that range of options for our customers, but also lower cost, and because we're going direct, and also much faster and more reliable. So it's a key part of our business.
Amazing. And that ecosystem is not the only ecosystem you have to think about. You know, using Director Chopra's point, we got to think about the tech as well as the fin. I wanted to talk about digital ID a little bit. I mean, as finance overall becomes more digital, financial inclusion so important. Is there a role, like, how do you think about digital ID as balancing that financial inclusion with safety and as you mentioned before, kind of risk reduction?
Yeah, there's a couple policy points that I'd make. One is around digital ID. You think about that trust hurdle, and we collect from our customers' name, address, date of birth, social security number in the US context, or tax ID. And when you look at the systems for that kind of identity verification, it's actually pretty old and antiquated compared to what a lot of other countries do in terms of having a digital ID that is more portable and easier for customers to be able to verify their identity, which not only makes it easier to build trust, but it also brings the cost down. It makes it so it's even more effective to, I think, fulfill the intent of the regulatory obligations around any sort of nefarious activity. It makes it more accurate because you've got a digital ID. So there are privacy and other elements that need to be considered, but I think having a digital ID is one that is good for all aspects of the ecosystem. And the second policy element that I'll mention is, if you look at what drives price for customers, ultimately, it is collecting funds, dispersing funds, and it is still fairly expensive and or slow in the US context to be able to collect funds from customers. And so the good news is there are innovations like FedNow that are out there now, which would make it much less expensive. I mean, significantly less expensive, which could be passed along to customers. But unfortunately, the way the regulation is written is that outside of banks, you can't get direct access to FedNow, which is an outlier compared to a lot of other countries where highly regulated, I mentioned who are regulated, but highly regulated non-bank financial institutions have access to payment rails like FedNow. And so if, not just us obviously, but if global payments companies, remittance companies, however you cut it, have access to things like FedNow, it has a huge win in terms of bringing down the cost of remittances for customers. And I think the good news is a lot of folks are getting that now, and I think there's some momentum about that hopefully happening.
That's great. No, it's great to hear. You beat me to the first half of that magic wand question, which I love, and that access to those Fed rails, so important. You have a unique perspective, having worked with so many different countries. I'm going to give you that magic wand back one more time. If there's anything else that you could beg, borrow, or steal from another market that you've worked in and want to bring to the U.S. to improve the operating environment for you and for more importantly, for your customers, like, is there anything else that you would want to bring here to the U.S. financial system?
Mm-hmm. I think, honestly, I would plus one what I just said.
Same one? Okay. It makes sense. No, it's important. It makes sense.
And it would have a transformative effect on just faster domestic rails and adoption and equal access to those rails is what I'd say. So
I love it.
I'd repeat it.
I know exactly why you've loved FinTech from this conversation, so thank you so much. We've got a couple seconds left. What's one thing that you think everyone in this room should know, not just about Remitly, but about FinTech as an ecosystem?
Yeah, I would say some of the themes we've talked about, especially in the consumer space, it starts and ends with trust. That's what it's all about. And the second thing I would say is that, in some ways the U.S. has some catching up to do in terms of the regulatory and product development when it comes to supporting fintech. But there are models around the globe that we can look to, like FedNow access, and looking to Europe, looking to India with UPI, looking at PIX in Brazil. So how do we in some ways get faster at replacing legacy rails, which in some ways is harder than what other countries have done, which is leapfrog to a future that we're all headed towards. It's just a matter of how we get there faster. And I think from a regulatory and policy perspective, there's a lot we can learn from the globe in this way.
Perfect. Well, thank you for bringing that global perspective for all of us today, Matt. Appreciate you being here. That is it for us. Stick around. We've got 2 more great interviews. You're going to hear from Big Bank, from BNY, from Carl Slicki in just a moment, as well as then Senator Lummis after that. So thanks, everybody.
Thanks, everybody.
Please welcome Carl Slicki, BNY's Executive Platform Owner, Treasury Services. He's joined on stage by Liz Hoffman, Semafor's Business and Finance Editor.
Carl.
Hey, Liz.
Thanks for joining us on this very steamy day.
Thanks for having me.
Look, the U.S. just lags way behind a lot of other countries in pick your digital payments, fintech adoption broadly, despite, I think, being a pretty tech-savvy country with a lot of venture money put into this stuff. People still go to bank branches. People still write checks. Like, what is it going to take to drag everyone into 21st century here?
It's a great question. I think when you look at what a lot of other countries are doing with payments innovation, moving off of paper to kind of more digital experiences, it's interesting. The dynamics in the US are so uniquely different versus so many other countries. So you take Australia, take Singapore, take India as an example. They were able to implement a new instant 24/7 digital payment system. You get a couple of top banks to adopt it in unison with each other, and instantly you get 90, 95, even 100% ubiquity across the market to those providers. And historically, and I think in a lot of those cases, they were coming from places where what they had previously was so far behind common technology that what they implemented was such a unique and advanced consumer experience that the adoption curve really boomed, because you're really advancing and really moving the entire industry forward. In the US market, however, because we have 9,000 plus banks between commercial and credit unions, we have a very dynamic network of players, and we were actually, to your point, much more advanced in common user experiences where we had perceived instant and digital experiences all over the ecosystem, right? You could do so much on your app, et cetera, even though a lot of the financial things behind the scenes were maybe delayed, batched, later, 2-3 days, the little disclaimer, your money will be available in 1 to 3 banking days and those type of things. So the consumer experience of resetting that infrastructure is, oh, I thought I could already do that, right? When you're talking to the general consumer.
Exactly. What you're saying, yeah.
Well, so I think we're getting there. We're working through with RTP, that's launched in 2017. FedNow launched last year. We actually are resetting a lot of the financial infrastructure of the US to move to more 24/7, 365 instant processing. But we have a lot of layers of adoption and maturity to go through to really kind of bring that out to all the users in the market.
Yeah. Speaking of FedNow, you were a founding bank there. Adoption has been, I think, slow. There are maybe 800 or 900 now out of the 10,000 you mentioned. What was the industry's pushback there?
Yeah. So again, with instant payments in the U.S., right, and it was kind of interesting development. It was 40 plus years since we launched a new payment system for the U.S. when RTP launched back in 2017. BNY was the first bank to actually join RTP back then because we really truly did believe in the long-term value of what this will bring to the U.S. economy, both in terms of businesses, small business, down through consumer, to really just give them more transparency and visibility over their finances, control over their liquidity, right, and kind of bring the account holder back to more transparent control over their own payments and transactions. So when you look at, kind of back to the original comments, we have 9,000 banks to implement this to really get that benefit all the way downstream. Your point, we're about over 800 right now. It actually represents about 70% of all accounts in the US today can receive an instant credit 24/7, 365 from their payroll provider, insurance company, phone provider, government disbursement, et cetera. It's actually pretty good adoption when you think about it. I think what the challenge is there's a huge long tail of banks in the market that we're going to have to continue to work through to bring that aggregation point. I think the good thing is a lot of them are using common technology providers behind the scenes that have adopted it. So it's really kind of an implementation phase game that we have to kind of go through in the coming years to kind of put all those pipes in place. The really long curve, and it's interesting, ACH has been around nationally since 1974. We're still innovating really cool things we're doing on top of ACH right here, 45 plus years later. With RTP, FedNow, what I'll kind of generally refer to as instant payments, I think the use cases on getting it to be applicable for business-to-business payments, account, AP, AR, whatever it may be, gig economy, I think this is going to be a long-term game, and we're going to have to kind of work the dynamic of, in the U.S. economy, we also are not shutting down old systems either, right? We're still continuing to keep checks alive. We still, the card rails, ACH payments, wire payments, things that are over those rails will continue to all coexist. And the banks and the fintechs and those providing solutions are going to have to find ways to not pass all that complexity down to the end users, the businesses and the consumers that are actually benefiting from this at the end of the day.
The Fed has not released any data on the volumes going through, which sort of suggests it's not that much. What have you seen maybe directionally with your client base as to who's using FedNow versus RTP?
Yeah, so I think RTP and FedNow, so this is an interesting point. I think typically a lot of the market thinks of RTP or FedNow, right, and one or the other. We took a very direct approach to this very early on where we realized that like other payment networks, right, you have the clearinghouse and the Federal Reserve, they both operate ACH, they both operate wires, they both operate check clearing in the US. So just like those other rails, they're both operators of instant payments in the US. And given there's 9,000 banks to reach, we actually do need both players to really kind of saturate that. What we actually did between the two is we've connected to RTP, again, first bank there, we connected with FedNow as part of the pilot participants to launch that. We bridge the gap as for a single instant payment solution for our clients. So anyone who banks with BNY, if you can receive a payment from both of those rails, you get it as an instant payment. And if you want to send a payment instantly, we'll check both networks to see where that endpoint is. Is that beneficiary at a bank that's on this network? Are they on that network? And we'll simply route it to, again, kind of take the complexity of a fragmented system away from our client and just bring them a broader instant solution that can actually reach both networks. So to us, we really want to sell and promote the value of instant payments, network agnostic, and let both of them continue to build and expand and bring that value. And what we're doing is, I think there's a lot of early adoption on use cases where there's a business that can choose how that gets paid, and there's a consumer on the receiving end of that. So think about B2C disbursements for insurance claims or refunds, and there's a value to a consumer getting that instantly 24/7. We piloted years ago using it for e-bills to help a phone company provide e-bills to consumers and pop it on their phone to provide that back. And we also see a lot of growth in account-to-account funding, where consumers are using it to just instantly fund brokerage accounts, and they can do that on 10 a.m. on a Saturday when they have a free moment to actually go open a new investment account and use RTP to fund that.
Right now, the pricing is the same. The Fed said
Correct.
They didn't want to come in and be a disruptive second mover. Do you expect that to continue, and sort of how does that sort of change how people use these?
Yeah, absolutely. So it is the same at the moment. I don't think there's any reason to think that it won't continue to stay the same. I think they're both networks, and BNY is one of the owning banks of the clearinghouse. We work very closely with the Federal Reserve financial services team on the development of that network. We're very invested on helping both of them grow the model, right? And it's getting more banks on, helping promote use cases. I think one of the things that I think a lot of the public doesn't realize is the amount of players you need to really mature each use case is really complex. So what we're doing is we're actually spending a lot of time bringing our clients, who are other banks, corporates, fintechs, to the table to kind of bring their voice on, say, what would you need to actually use RTP or FedNow more to help your business case or your consumers or business partners leverage this, and try to bring that into the circle of both the people at the Fed and the clearinghouse to say, here's how we think we should work together to build a common experience, to get banks to move in unison, to build a network effect around a use case or messaging scheme or whatever it may be, and trying to kind of think about where can we add the most value to the market with all of those players representing consumers, representing business interests together, because you really do need network effect for those type of use cases to flourish.
Does faster payments just mean faster fraud?
It's a great question, and that's a very common thing that we hear for sure. It doesn't, right? And so far, it hasn't meant that in terms of the proof points and what we've seen on the networks. Again, RTP has been around since 2017, and there's millions of transactions every month going over that network today across the U.S. economy. I think, though, when you look at fraud, we spend a lot of time talking about fraud and risk management in the banking space, specifically in payments. And I think if you look back at how this has evolved over the last several years, historically, there was a lot of focus on unauthorized debits. I'm getting a little technical here, but people pulling money from your bank account, and did they really truly have authorization to do that? And Nacha did, I think, a fantastic job putting a whole new rule set, a lot of education into the market, putting new thresholds in place, putting new enforcement actions on cutting down on unauthorized debits to consumer accounts. And that's actually been effective, and there's a lot of statistics backing that up. The focus now, though, and if you look at the news, and you kind of see this on a number of spectrums, is authorized credit push fraud or scams, right? And this exists in the business space where you see B2B email compromise, where someone is, hacks an email, photoshops an invoice and says, hey, business partner, send your next payment over here, right? And they're trying to scam an AP team for a large business. Or consumer scams, right? Look at romance scams, look at puppy scams, selling fake concert tickets, whatever it may be. These are continuing to perpetrate, and there's a lot of consumers that are still getting burnt by some of those scams. So when you look at this and think about what can the financial industry do about it, the answer, I think, is more. And what we typically try to push for here is when you think about all of the banks, 9,000 banks, all the corporations in the US, what we don't do is talk to each other enough about fraud information sharing, right? You have fraudsters that know if I go to this bank or this corporation, I'll perpetrate this scam, get as far as I can get. Once they catch me, I'll just go next door because I know they don't talk to each other. What we need to do is the data is there across the networks, across the corporations. We have to really figure out a way to do better data information sharing in a secure way that respects data privacy, but helps highlight where the scammers are coming into the market.
But everyone, the Venmo problem, right? Like, as friction has come out of the system, and it's going to continue the bigger the instant payment stuff gets, you send money to the wrong person, you can't get it back. And so I wonder if this is one of those places where actually a little friction is not the worst thing.
Right. It's always a balance between seamless instant consumer experience and friction for protection. But in that example, right, you go to a digital wallet or a bank and you say, hey, I want to send money to my friend here for lunch. And they may say, Carl, you never paid this person. Are they new? Do you trust them, et cetera, et cetera, et cetera. But what would be more valuable, right, and just use this as an example, let's say that individual just sold 500 fake puppies to people all across the US, and you're about to send a payment saying thanks for the golden retriever. Wouldn't it be valuable if your provider actually said, hey, Carl, by the way, we actually just recognized a really big scam because we took all this market data and we're going to use it to implement even more friction because there's data we can use to make this a bit more of a frictionless friction process here to help protect you. What we're not doing now, and I think in scale, is that exactly. Identifying where those trends are coming up, sharing that data, and if you want to read it, Nacha put out an article and a white paper on this for a new risk management framework to actually monitor receiving bank activity on inbound activity, to raise the bar on who's monitoring the inbound activity to that scammer, and what can we do with that over time to actually protect the senders in the market more systemically.
Oldest bank in the country. You like to think of yourself as a fintech. I know you don't trade like a fintech, you trade like a bank. But broadly speaking, I think the big banks have had trouble when they've tried to incubate these things internally. Think of Goldman Sachs and Marcus, or JP Morgan and Finn. Talk a little about why that is and how you guys are trying to avoid kind of stepping in that same puddle.
Yeah, so BNY has an absolute tremendous history. So we were celebrating our 240th anniversary this year. This has been a pretty exciting moment at BNY. And you're absolutely right. We have a long reputation of trust and safety that we don't take for granted. We totally believe that resiliency is commercial and that people use that trust to rely on us to keep their assets safe. And with that, we're also not afraid to innovate and be on the bleeding edge of a lot of areas, to your point. And we really believe in doing it the right way. So when you look at the fintech space, right, and who BNY serves, right, we don't have a big retail branch presence. We don't serve small business banking. We serve banks, broker-dealers, investment advisors, Fortune 500 corporations, government entities, as well as fintechs who are providing financial services. And there's two core ways that we partner with them that we found to be successful. In a lot of cases where we have accounting capabilities, liquidity solutions, trade finance, payment capabilities, there's certain use cases in the market that require a great user experience, workflow orchestration for accounts payable, receivable, payee choice disbursements, biller direct portals, et cetera, and we found a whole array of fintechs that we've actually either invested in or brought on as our vendors to package their technology with our accounts and payment capabilities to provide a really great BNY branded solution end-to-end to our customers. So in a lot of cases, we have a whole portfolio of entities that we've done this with. In addition to that, we also found a number of fintechs that we can partner with to help actually provide them secure financial services, to provide them subledger capabilities or payment experience, or actually hold deposits for them, to provide safe, regulated capabilities in the bank space to fintechs that are really good at innovating for their specific experience that they offer into the market.
Just a little time left. Gina talked to Director Chopra earlier about this exact situation, right? What you're saying. Is it important, do you think, how much of this is down to education? Is it important that people understand that this fintech is a screen and not a bank? Or if you guys do your job well enough, should it not matter?
Yeah, absolutely. I think there's certainly a responsibility that every player has to be transparent to the consumer about what they're doing and where they're putting their funds and who's behind that. Is it just a fintech? Is there a bank? Is it FDIC insured? And really, the banks that are involved in that, making sure that as you build those programs, you're doing the right things from a ledger perspective, from a KYC perspective, from a transaction monitoring perspective, et cetera. I think there's absolutely a responsibility of all the players in the ecosystem, because we're only as good as the weakest link. So the trust in the financial network is super critical. But I think there's a right way to do it, and there's a right balance for a bank to structure a program, to work with the regulators to figure out the right way to do that, and be ultra transparent. But education and transparency, I think, is what we have to keep raising the bar on.
We're going to have to leave it there, but thank you so much for coming. Thanks for the time.
Thank you. Appreciate it.
Please welcome Senator Cynthia Lummis of Wyoming. Liz Hoffman remains on stage for this conversation.
Thank you for joining us. We will talk about fintech, I promise, but I do have to start. The entire world is watching Washington right now. Obviously not your circus, but Republicans had their own messy kind of internecine leadership scrum last year. Any words of advice for your friends across the aisle?
Well, I feel for them in a way that makes me pleased that we're not in their shoes. They're struggling. But we're used to, as Republicans, taking tough questions around Capitol Hill. And in my opinion, seeing the other side of the aisle get less tough questions, that has reversed this week. So we're seeing a really different scenario than we're used to seeing on Capitol Hill. And we're seeing also this unique Republican Party platform that just came out day before yesterday that is very simple, very straightforward, 20 points, very much orchestrated and directed by President Donald Trump as the agenda he wants to run on. And you're seeing people in Congress saying, this is great, we love it, we can support this, we're going for it. So we're seeing an very odd circumstance where Republicans who have a tendency to think for themselves and therefore struggle to unite, we're seeing my party very united, and we're seeing the Democrats kind of struggling to find a sure path forward. So very different scenario that's happening on Capitol Hill right now.
You mentioned the GOP platform, and one piece of that struck me, and it ties into this kind of, I think, ascendant crypto wave in certain Republican political circles, really. Yeah. And I think the animating principle is that we need crypto because the federal government is going to make it impossible to use your dollars to buy guns or whatever it might be, right? Because there was some sense about staying out of government surveillance in the GOP platform and the payment system. Is this a partisan issue? Do you worry about like the dollar being weaponized? Is that the use case for crypto?
Well, it is a use case for crypto, and we have seen currencies be weaponized. We saw it with the Canadian truckers. You'll recall in Canada that during COVID, truckers were protesting. Something like 250 plus Canadian truckers and contributors to them had their bank accounts frozen by the government when Trudeau was given extraordinary powers. And later, much later, after some of these truckers had been destroyed by having their bank accounts frozen and their trucks seized, the courts in Canada found the use of those extraordinary powers to freeze bank accounts to have been an overreach of the extraordinary powers of the Canadian government. So we've seen it happen just north of us, and so there's tremendous concern among people who gravitate towards digital assets, especially Bitcoin, that it is freedom money, that it is something that allows people to protect their money from surveillance. We also see surveillance in the CDBC that the Chinese have created, the digital yuan. It's very much a means of surveillance. So there is a tremendous suspicion, particularly in my party, about CDBCs. I certainly don't support the US having a CDBC, certainly direct to retail. And systems behind that wall that allow central banks to transact among each other, they don't really need it behind that paywall among those central banks. So they've got their own system that works pretty well. And so I think you'll see resistance in my party, certainly, for a CDBC, and definitely concern about protecting freedom and sovereignty of individuals over their financial assets.
Okay. You introduced a bill in the spring that would make it easier for institutions, particularly banks, I think, to custody crypto, which I think is seen as a step towards sort of wider investments and adoption. Where does that stand?
Well, currently, I had sponsored, along with Senator Kirsten Gillibrand of New York, a complete digital framework for assets that come in a digital format. It was everything from Bitcoin to cryptocurrencies to stable coins and NFTs when they function in a financial world. So Senator Gillibrand and I have in common the fact that we believe in the dual banking system. Both of our states, we think, have strong state banking systems that we want to protect and nurture and allow to participate in the growth of this asset class, the asset class of digital assets. So we wanted everybody to see what the whole package looked like assembled in one document. The way the Senate works is there are 4 different committees of jurisdiction over different aspects of that bill. So if we had just sent them individually to each of those 4 committees, people wouldn't have had a chance to see how it all fits together. But now it is being taken apart. You know, the House was able to pass a framework all in one piece. The Senate really can't do that. So what's happening is the Ag Committee, which has jurisdiction over the Commodity Futures Trading Commission, and any digital asset that is a commodity, they are moving forward with legislation. Now, they haven't scheduled a markup yet, but I think that they will mark up the CFTC component of this. I also think if they do that and then bring that vehicle to the floor of the Senate, that it becomes a vehicle that other financial service-related legislation can be attached to. And I do think that Senator Schumer wants to see that happen. So I think he's being a very positive force in facilitating that strategy. Now, the Senate only has, believe it or not, after this week, 5 more weeks in session before the election, which is shocking even to me. And when you think about how precious floor time is between now and November, to have only 5 weeks to allocate to the NDAA, to whatever financial bill we have, to our entire federal budget, which has to come up, at least in theory, before September 30th. That's not a lot of floor time. So I'm glad that Senator Schumer is putting a priority on this, but it's a heavy lift even for him.
I think he's pretty busy this week with some other priorities.
Indeed he is.
We talked to Director Chopra earlier about the Supreme Court decision, Chevron. You, I think, have not been a huge fan of regulators. You've had some tough words for the SEC. How do you expect this to kind of ripple out and sort of broadly a push against a bunch of financial regulators on a bunch of fronts? You sit on the Senate Banking Committee.
Yeah, I see it a challenge to Congress to write legislation that's way more specific. Over the years, I think the Congress has gotten used to writing very generalized language and then deferring to regulators to flesh it out. We shouldn't do that anymore. We have given the executive branch too much leeway to shape legislation, and so we're going to need to be more diligent at the legislative level about saying what we mean and meaning what we say. And I think that's going to be true with banking as well. So for those of us who are really concerned about the trend of the SEC to what I would call regulate by enforcement action, instead of by putting out clear rules and standards to which especially digital asset providers can meet standards that will keep them out of enforcement actions. I just think we're going to have to be more specific.
But this is complicated stuff. And,
oh, man,
and respectfully, Congress is not known for being very tech savvy as a whole. How do you make sure that whatever bill you're writing is specific enough that it does not get deference, but also makes sense and is helpful?
Yeah, I got to tell you, Wyoming really has been a leader in this regard. Wyoming passed some of the first laws to deal with digital assets, mechanisms like SPDI, Special Purpose Depository Institution. And then we not only passed the law, the first law, but through our state banking regulator, passed all of the examination manuals. And this was all done before President Biden took office. So we had 900 pages of bank examination manuals for SPDIs, including compliance with AML and BSA and anything that a bank regulator could throw at a special purpose depository institution. And yet, at the Fed, businesses that wanted to organize under Wyoming's SPDI statute cannot get, master accounts.
And there's a case that's going to, that you've weighed in on with Custodia that's going to, I think, kind of decide that question.
I sure hope so, because it's been a source of tremendous frustration. And I think is yet another example of the concern that I have that the federal government has disregard for the dual banking system, and that we need to punctuate legislatively our support for the dual banking system.
It's looking increasingly possible that Republicans take the Senate.
From your mouth to God's ear.
Priorities for the Banking Committee if that happens?
Yeah, I think that we will see greater emphasis on digital assets. The other party seems so focused on sort of the criminal use or illicit use of digital assets. And even though we've had companies like Chainalysis come in and testify in front of the Senate Banking Committee that it's easier to solve a crime committed in Bitcoin than it is a crime committed in US dollars. But somehow that sworn testimony is completely disregarded. We do have in the other party very powerful and influential skeptics on the Senate Banking Committee. And so we may have to still deal with some of them, but hopefully coming at it from a majority party position, I think that we may be in a better position to help shape a future for digital assets that protects individuals' personal privacy and personal privacy information, and yet provides more of a framework for using digital assets and incorporating them into our economy. For example, you have people like, I'm very interested in Bitcoin, but I'm also really committed to the full gamut of regulatory framework. You have J.D. Vance, who's on the Banking Committee. He's very interested in some of these utility coins. You have Tim Scott on the Banking Committee, who would be the chairman of it if he's not selected as Vice President of the United States. Of course, J.D. is also being vetted in that regard. So we have some key Banking Committee members that might not be around, but also might be at the White House. And as you pointed out, it's really been incredible to me to see how, in his public statements, former President Trump has embraced digital assets, specifically Bitcoin, but other cryptocurrencies as well, and how now the Republican platform has. And I couldn't be more pleased. But I think what that does is almost poses a challenge to the other party to defend their position that these assets are not legitimate or should not be streamlined into the everyday economy. I really think Republicans are going to prevail on this and sort of nurture some of the skeptical Democrats to come our way.
You stepped on my next and probably final question, which is, probably hear about a VP pick next week. You mentioned people in contention. Thoughts?
President Trump, I truly believe, chose well last time. I thought Mike Pence was a wonderful vice president. I had served with him in the U.S. House. We were friends. He was a rock-solid guy, and I thought he did a rock-solid job as vice president. I think Trump will choose well again. When he is asked what his main criteria is for choosing a vice president, he says, I want to choose someone who is capable of being the president of the United States as his first criteria. And that should be the first criteria. So I think that he'll choose well.
All right. That's all the time we have. Thank you so much.
Thank you.
Please welcome back to the stage Semafor General Manager and Global Head of Public Affairs, Bennett Richardson.
We'll make this quick. Thank you all so much for being here with us today. Thank you to all of our wonderful speakers, to Senator Lummis and Liz Hoffman for finishing up. Thanks again to Penny Lee and the entire team and members at the Financial Technology Association for joining us. If you want to hear from more financial regulators and more members of Congress like Senator Lummis, mark your calendars for our biggest event of the year, the World Economy Summit. I know many of you joined us in April for the Spring Meetings edition. October 24th and 25th will be our fall edition of the World Economy Summit. So join us then for that. We'll have a whole bunch of events in the meantime, so make sure you're signed up at semafor.com to our newsletters to hear more about that. So thanks again for coming. Join us for some lunch and some networking outside. Appreciate it. Thank you, guys.